This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're now going to go through and look at that fair value of consideration figure that is contained within the goodwill calculation. So remember, the goodwill is calculated as the fair value of consideration. We then add on the non-controlling interest either at fair value or based upon the proportionate share of net assets, and then we deduct S's net assets at acquisition. Here we're going to be looking at the consideration, because what we've seen so far with regards to the consideration is that the parent has quite simply paid cash to buy the investment in the subsidiary. So they will have credited cash and debited the investment. In reality, however, when a parent is acquiring a subsidiary, it won't just pay cash immediately. There may be some other forms of consideration as well. And some of them are listed there. Okay. The first one we're going to go through and look at is a share for share exchange. Now, remember, what happens when we pay cash is that we pay cash, and in exchange for that payment of cash, we receive the shares in the subsidiary. Now, what goes through there and happens within a share for share exchange is that we still receive the shares in the subsidiary that give us control, but instead of paying cash, we will issue some shares of the parent. So if we're issuing shares of the parent, we need to think about the journal entry. So let's just look at the bottom bit there in terms of what the journal entry actually is. So we're still debiting the investment. Right, when we paid cash, we debited the investment. However, instead of crediting bank, we're now going to credit your share capital at the par value, and then we will credit your share premium. Okay. Again, what we need to be careful of there is that when we're crediting the share capital, crediting the share premium, we need to perform that in P's books. We also need to debit the investment in P's books, but we're going to eliminate that investment on consolidation. However, here, when we're consolidating, remember we record 100% of the parent share capital, 100% of the parent share premium. So whatever credit to share capital and share premium we have, if it hasn't been recorded, we will need to go through there and record it. Okay. So that's the aim. That's the focus. That's where we are heading towards. However, how do we get there? Okay. Well, there's a 3-step process before that 4th and final step. So first of all, we're looking at a share for share exchange. So we need to look at the number of shares that we have acquired. Okay. So we need to look at the number of S shares that have been bought. Okay. So we will be looking there at the number of S shares that are in issue, and then looking at the percentage of those that we have bought. So if we bought 80% of them, it is 80% of those shares that are in issue. We then need to go through that and look at the number of P shares that are issued in exchange for those S shares that are acquired. So it will be 1 for 4. So we will issue 1 share in P for every 4 in S that are acquired, or 2 for 5, or whatever it may be within the question. So looking at an issue of shares in a similar fashion to what you've seen when you were in financial accounting. The final bit of the jigsaw then is to value the P shares that you've issued. So from the second step, you know the number of shares that you have issued. You then need to value them at the price per share. Okay. Be careful. It's the price of a P share, because they are the shares that have been issued. Okay. And if you can follow that process, you're going to do well within the exam. This is a really, really, really common scenario that you see within a Section C type question on preparation of a group statement of financial position. Okay, so what have we got? Let's go through and have a look at the example. Okay, so what it wants us to do is to work out the cost of the investment. So effectively, that's looking at the valuation of the P shares issued, isn't it? Because that's whereby we will debit the investment. Okay. We then need to go through there and prepare the journal entry. So that's when we do the full credit share capital and then credit share premium, having valued the number of P shares that are issued. Okay. So it says Harry acquired 80%. So Harry has control. Harry is the parent of the 10 million ordinary shares of Sally. So Sally is the subsidiary, offering a share exchange of 1 for every 4 acquired. And the fair value of Harry's shares, so is that the parent is there as $3 per share. Okay. So what have we got? Well, remember, step 1 is to go through there and look at the number of S shares acquired, isn't it? So here we've bought 80% of the shares that are in issue, and they are 10 million $1 shares. So 80% of 10 million is 8 million, isn't it? Step number 2 is to look at the number of P shares that are then issued in exchange for the receipt of those 8 million S shares to give us control. And it is a 1 for 4. So therefore, we do 8 million divided by 4, which is 2 million P shares that have been issued. Step number 3 is the answer to the first part of the question, isn't it? The cost of the investment. So we can then value the P shares. So that is at P's share price. So that's 2 million at $3 per share, isn't it? So that gives me $6 million. Okay. So the cost of the investment is 6 million. Okay, I suppose I should be thorough and put the dollar sign there as well, shouldn't I? Okay. Step number 4 is to do the journal entry. So here we're going to debit the investment with the $6 million. And then we're going to credit share capital and credit share premium. So I'm going to make the assumption is that Harry's shares that they issue are the same $1 style par value. So what we've got there is that we issue 2 million at the $1 par value. So I credit share capital with $2 million, and the credit to share premium is that there at $4 million. Okay, there you have it. I've recorded the journal entry. I debit the investment, credit share capital, credit share premium. Again, just points to note. When you debit the investment, that is then eliminated on consolidation, isn't it? Because it's an investment in Sally being the subsidiary. And then what we need to go through and do there is the credit to share capital and share premium. That's a credit to share capital and credit to share premium in the parent's books. So therefore that would need to be included on consolidation within the equity section, because we have 100% of the parent share capital and 100% of the parent share premium. But don't worry too much about that just yet. That's maybe going a bit far, but I just thought I would mention it. Okay. What I would do is I would practice questions like that now. Have a look at your study text. There will be some examples. There will be some illustrations within there. Have a go at those before you then move on any further.